going to get started. Welcome. Appreciate you joining us here. This is episode 10 of Dishin with Diane, a fireside chat. Of course, we are without fireside today because of our weather, so we've had to change up the studio a bit and find a cozy place where we can stay dry. So that's how we're rolling today. And, you know, as I've learned through this whole journey of starting this back in January of 2021, flexibility and rolling with the punches is key. So just another shift. But anyway, we are going to be talking about taxes. And, you know, next to only one other thing, we are certain about taxes. So it's a little bit better to talk about that than the other subject. So we will talk about taxes. We're going to dive into some different aspects of, you know, around home ownership, home office, write-offs, a myriad of things, as well as take your questions, which we always do. If you joined before, you know we take your questions live, and we're happy to answer them as we go. So without further ado, I'm going to introduce my guests here. I've got Jody and Ryan. They are from Mitchell Nemitz, a local PA firm here in the Wake County area in Wake Forest. Is your office?
Yes,
yep.
ma'am.
So anyway, I'm going to let them tell you a little bit about themselves.
I'm Jody. I've been with Mitchell Nemitz almost 4 years now, actually. I officially got my CPA license this past year, and I'm very excited. I have a little bit of a different background than most CPAs because I actually have degrees in chemistry and anthropology. So if you want somebody that knows a bunch of different things, I can probably help you out.
That's great.
Well, I'm Ryan. I am a partner in Mitchell Nemitz. I've been there probably a little bit over, I guess, 21, 22 years. I do not have a degree in chemistry or anthropology, and thankful I do not have degrees in those. Our firm has been in Wake Forest for over 30 years. And we just love the Wake Forest community.
Awesome. Wow. 30 years you've been.
Yeah, I think we're the longest standing
Oldest.
firm
Oh,
in
really?
Wake Forest.
In Wake
Yep.
Forest.
Well, that's a great accolade to have. That's awesome.
Thank you.
Well, I really appreciate you guys taking time out of what I know is a very busy schedule. And we just want to chat some because these are the kinds of questions that sometimes I get, you know, as a real estate agent. These are things that people want to know about. And these are important topics, and especially maybe money-saving topics for people. And necessarily it doesn't have to be that they have bought or sold a home, right? There's a lot of different things we all can understand better about taxes and what we can do and not do and the rules that change and all those things. So I don't know where you want to start. I'll let you kind of pick our first topic and we'll just go from there.
Where do you want to start?
One of the biggest disappointments we've had to give people lately is about home office stuff. Unfortunately, if you're a W-2 employee, there is no longer a way to write off home office, and especially with all the COVID stuff, we've had a lot of people very upset about that answer.
And that changed when?
2018.
So it was
Yeah.
even before COVID that
Yeah.
it wasn't allowed, and then it
Correct.
didn't adjust as a result of COVID is what you're
Right.
saying.
Correct. Now, if you're self-employed, you still can do the home office write-off if you file a Schedule C, a Schedule F. It's also available if you have rental properties, like for Schedule E. And so and then you have, you know, your regular home office method, and then you also have a simplified home office method that you can utilize as well.
Okay. So what are some things that if you plan to write off a home office, what are some things people need to consider, think about?
For a home office that would be home office expenses.
Yeah. What are some things?
Utilities. Insurance is the one that I see missed the most. Mortgage interest, pretty much everyone thinks about.
Real estate taxes. You can also do things such as like pest control, homeowners dues.
Oh, really? A percentage of those things
Yep.
as it relates to the space you're using?
Yep.
Right, correct. If it relates to the whole house, so like for instance, if repairs and maintenance on your house would qualify, but it's not if you had to repair like your roof, or you had to have your HVAC repaired or your siding repaired, things that are going to be specific to your entire house, where if you had to paint your kitchen, that does not qualify.
Okay.
Right? Or now things that you do specific to the home office, like if you painted just your home office, that would be a write-off.
Okay.
A
Or bought new
specific
furniture for it,
furniture.
or things of that nature.
Right. And those
Okay.
would be things that would not be written off on the home office form. You can write those off 100% on your Schedule C, your Schedule E, or your Schedule F with that, because those are specific to
That space.
your home office space. With
Okay, so there's a distinction between anything you do specific to the home office space itself and what can qualify, and then what you're saying is anything that's kind of whole home impacted, you can take a portion as it relates to your office space and apply that. Good to know, because we did our HVAC this year, so sounds like I need to be
Yeah.
thinking about that and getting that in order. Okay.
The important piece with that is having that dedicated office space and knowing the exact square footage of that versus your home.
Right. Yeah.
So you can't have a little desk in the corner.
No, it doesn't
Next to your
count.
whole
That's
bedroom.
your home
That
office.
doesn't count, huh?
Or
Okay.
you can't shove off, have half your dining room table as your
And that's
home
not
office.
it? No.
That does not qualify. So.
Okay, so got that, folks. You need to have a dedicated true space that's in the home, that is an office that you're using, and then you can do certain write-offs as it relates. And unfortunately, if you are an employee of somebody and you are working out of the house, which I know many more are, it sounds like there's not the same benefits on that front. So,
Now, also a note on that the deduction for the unreimbursed employee business expenses that the home office would be part of comes back into play after 2025, because the 2018 tax law sunsets after 2025. And so some of these provisions will come back into play. So it's not a matter of that you won't ever get to do that if you're an employee. It's just
Right
through
now.
2025.
2018 through 2025.
okay. All right. So, hang in there. Maybe things will change, All right. So, what else? I think another interesting topic, because many people have bought and sold in this past year. And I just wonder, what are some of the things that anybody who's sold or bought a home need to think about as they prepare for 2022?
The most important thing is differentiating between your personal home and if it's a vacation home or a rental home. Rental homes and business homes are taxed differently. Your personal home is taxed as a gain, but you have the potential for an exclusion up to $250,000 per person if you've lived in that home 2 of the last 5 years.
Right, and so that would be 250 single and 500 married filing joint. And I think some of what people, especially if they're selling a principal residence, they have to make sure they meet that 2 out of a 5-year rule. The 2 years does not have to be consecutive.
Right.
And so if you use it as your principal residence 1 year and then you stop using it and then you start using it again, as long as it's 2 years within that 5 years leading up to the date of sale, it can still qualify.
Okay.
It's also applicable if only one spouse is living there. So if you get married and you both have houses and you sell one of them, it is acceptable to exclude.
Correct.
Okay. So so there's the 2-year, not consecutive, but 2 years over the 5-year period, you've got to own, got to live in the space in order to avoid the capital gains tax.
That's
Right.
correct.
Right. Okay. So I oftentimes, when I see someone's only owned a home a year and a half, and they're thinking about selling, I'm like,
Try to hang in there.
let's hang in. Maybe let's make it to that 2-year mark, so at least you don't get the capital gains. So that's good advice. But what if you bought a home? What do you got to think about? So you're on the buy side. What are some things with that?
Thinking about if you can itemize deductions, you want to keep track of that mortgage interest.
Yeah, and there's really, if you're buying your principal residence, there's really not a whole lot that you can deduct besides maybe like your loan origination fee, if it's your primary residence, your mortgage interest, your real estate taxes, because aside from, unless you have a home office, you can't deduct your homeowner's insurance and those kinds of things, and a lot of your other common closing costs such as attorney fees, stamps, recording fees, appraisal fees, inspection fees. You can't take any tax deduction for those. Those just have to be added to your cost basis in the property because those are considered acquisition costs of your residence. So, and that could come into play depending on when you sell your principal residence. And do you need to try to get your gain down any if you're selling it before 2 years?
Yes.
Okay.
Always keep track of anything you put into the home as it can be added to your basis to decrease that gain.
Right. Right. Especially big improvements, putting up fences.
Okay. Yeah, you deduct them off the top is what you're saying of the gains. So if you put in a new HVAC, water heaters, those kinds of things, you can deduct them out when you go to sell your home and reduce them off your capital. And that reduces your taxes.
That is correct. That is correct.
Yeah.
And that would apply too for even if it's not your principal residence, if it's a rental house or a second home, when there could be some gain related to that sale. So making sure you're keeping track of that and maintaining the documentation. So, we've had people before that have been in that situation, and they did an improvement from 15 years ago, and they no longer had the receipt or the documentation for it. And so keeping track of all that can be very important.
Okay, so tracking, making
Save
sure
everything.
Save everything, keep all your documentation, and just be mindful of what you can and can't do when you sell a home, buy a home, and some of the tax opportunities that you have available to you. Definitely, if you've got an accountant you're working with, certainly make sure you're asking these kinds of questions and getting the proper guidance. So another write-off I think that we all, have is that insurance. What is it? The insurance, right? Mortgage insurance or our
mortgage interest.
But then also your home insurance. What other insurance? There's the home insurance, right?
Homeowners insurance. You got PMI.
Yes, PMI is all that written off.
The PMI, there is a mortgage insurance write-off.
Make sure the mic's near him, 'cause
There is a mortgage
there you go.
insurance write-off that is part of your itemized deductions with that.
Okay.
But the thing on the mortgage insurance write-off is there's an adjusted gross income limitation on it. So if your adjusted gross income goes above a certain limit, you can't deduct that mortgage insurance as part of your itemized deductions.
Also only available until you refinance, correct?
Correct.
Yeah, and then when you lose the PMI, if you
Right.
lose PMI, obviously you couldn't write it off, right? That
Correct.
would make sense,
Correct.
right? So
Correct.
there. So just some food for thought on different things with home-related tax implications. We've covered the ground if you're just tuning in, from home office deductions, what qualifies. If you're self-employed, yes, you can deduct this portion of your home that legitimately is an office space, and then all associated costs related to that. If you're employed by another person, W-2'd, it seems that that's not an option that you can take advantage of, at least not right now, maybe in the future. And then we talked about the selling implications and making sure you're mindful of those capital gains and when and how those would kick in. And then if you've bought a home, what are some of the tax deductions you're able to make in that process? So just keeping good records and tracking any expenses that you do to your home, your property, is really smart to do. So keep a good file.
Yes.
What else? What else can we chat about with our...
Keep a good file is pretty solid in any aspect, especially right now with economic impact payments or stimulus payments coming out and child care payments coming out. You want to keep track of exactly what you got. Your tax software or your CPA or accountant is going to ask you those amounts, and you're going to need to have them on file. And a lot of banks lock you out of your bank statements after a certain point. So you want to go ahead, get that written down, know exactly what those amounts are.
Okay,
And for
that's
things
good.
like
Yeah.
that too, there are ways. There's you can get a I guess you can get a an account set up on like the IRS website, and you can get in there, and it'll tell you certain information in there if you're having trouble finding it on your bank statement or in your records with that. So you've got the ability to do that as well.
Okay, so yeah. So keeping track and making sure you know all the numbers, what you've been paid with all these stimulus incentives and things that you may have gotten, unemployment and or, child care, all the different things. Keeping records is key so that you can get the proper.
Even the ones that you don't necessarily get forms for.
Oh, okay, yeah. Just write it all down. The best advice, right? Write it down, keep it track, have a notebook, however you do it, spreadsheet, whatever works for you. Keep track. So yeah. So what else is important? Is there a question that someone has about taxes, about a situation we might be able to talk about? If you do, just pop it in the chat box, and we'll talk about things that might be relevant to what you need to know and want to know. And what else? What else you guys got for us?
One thing I'll mention is if you are somebody that owns business or investment real estate, you've got the ability, if you're selling business or investment real estate, you've got the ability to use the 1031 like kind exchange provisions. And the biggest thing that I would tell somebody is that you need to make sure that you put all of that into play before you close on the property.
Yes.
Because we've had people sell their business or investment real estate and then contact us after the fact to ask us how they can like kind of exchange the property. And the federal tax law does not want you to have constructive receipt of the money, so it normally it would have to go to a third-party intermediary to hold until you purchase that replacement property. And so that's just one of the biggest things that we will get asked on is about the doing the like kind, but they didn't follow through with the appropriate.
Yeah, and then you can't
on
take
that.
advantage of it. So yeah, there's a process for the 1031 exchange, and there are entities that operate as intermediaries. So one of the ones locally here is Investors Title. They are a big 1031 exchange. They have a big 1031 exchange arm of their title services. So something like that, depending where you may live, you might have an entity like that, but you want to engage them at a certain time frame before you touch any proceeds, before you sell anything. Basically, you can't touch and handle the monies, period.
The other one we run into a lot is clients not reinvesting the entire amount that they need to and ending up with gains on what is called boot, which is the money in excess. So making sure the entire amount ends up rolled into the new property is one of the key pieces. And that's where, again, the intermediary usually helps because they make sure you identify and use all of the proceeds. But
Yes.
we have seen where even they miss that.
Yeah, no, it's a great point. I've got a real client situation, and they've got two properties that are investment properties, and we were working to get clarity on exactly that because we were unsure if we sell, do we have to sell them both as 1031s? If we do, then do they have to have an equivalent of the total sale value? Can we use part of it, some of it? So there was a big discussion around how that works. So yeah, it was really good that we were asking the questions because that definitely helped inform the direction that my client is taking with response to those two properties. So yeah, those are all the things. And always, I guide people to say, talk to your tax, person when you're doing any kind of, real estate transactions, because there's always different implications depending on the time of year you sell, depending on what you're selling, whether it's personal or investment, etc. So that's always my advice, because I am not a tax person whatsoever. I use experts. That's why I bring experts on my show who know what they're doing, and then you have good resources to tap into when you're trying to do things to be the best service you can be.
Yeah, and
So.
I do think that's good advice to talk to a tax professional about it, because every like-kind exchange is a little bit different.
And different states have some different rules, right? On
Yeah,
some things.
Yeah, and and so finding out and walking through all the particulars of it to make sure you're not going to realize any boot, received, whether it's mortgage boot or cash boot, and how all that plays out, and then also making sure you're meeting the time frames of the 45-day identification process, as well as the 180-day close parameters.
Yes.
Yep. So there's timelines, and so basically, boot is just a fancy term for any proceeds beyond. I guess is you just want to be careful about that.
Something I've seen with that timeline and getting people in trouble is they often say 180 days or 6 months. That 6 months can get you in trouble because 6 months can be over the 180 days. So we actually had a client that was 4 days over the requirement just because they listened to the 6 months instead of the 180 days.
Literally counting 180 days.
Yep.
Because you got, oh, wow. All right, that's good. That's good for me. Huh?
So being careful about the exact number there.
All right. So questions? Someone got a question out there? Oh, I do. I see a question. Trying to read it. Sorry, we're a little sideways. What are the tax brackets?
Well, North Carolina's tax bracket is a flat 5.25%. The federal tax brackets are 10%, 12%.
We have cheat sheets at the office.
Yeah.
Are these for income brackets, or are these for
Yeah. 10%, 12%, and then I think it goes to 24.
Yeah, that's what I was thinking.
To 24 to 32 to 35 to 37. And each are a little bit different depending on your taxable income, and each have a little bit different taxable income ranges. Where married filing joint, has almost a double the single tax range, at least in the lower tax brackets. It's not quite double in the upper tax brackets. And then you've got, of course, your single. You got married filing separate, which is about which is basically half of the married filing joint. Then you got head of household, which can be a little bit different as well.
Okay, cool. And then, of course, there's the whole topic of, business entities and structures and taxes in there, which could be a whole other episode onto itself. Maybe we'll do that next year. We can talk more about business-related tax implications, and because more and more people are doing self-employment and or starting up businesses and things as we continue in kind of a, such a tumultuous time of opportunities and employment. So we'll put that one on the back burner for next year. So what other questions? I'm trying to read. I can see from here. What percentage do you pay in each bracket?
Well, you can go on the IRS website, or you can even just Google it and pull up 2021 federal tax brackets, and then it'll give you whether you're married filing joint, single, married filing separate, married filing separate just says half of married filing joint, or head of household, and it'll give you the tax bracket ranges. There is a 22% bracket as well, so I did just remember that. But I would do that because we, like Jody said, we have cheat sheets that we use as well. That we'll need to reference that.
Unfortunately, as accountants, we often live in the prior year until the new year actually rolls around. So half the time when I'm writing the date, I end up writing the wrong year.
Oh, yeah.
Everything's
in arrears. It's all there. So you're looking backwards. Yeah. I can see
and
that.
the 22 tax brackets will be changing some, and they'll be going up some as well.
Okay.
Just for, they normally increase a little bit.
Index for inflation.
All right. Cool.
Oh, and another thing, not necessarily related to tax brackets, but if you are a business owner who received a PPP loan in 2020 and were required to add back your PP expenses on your North Carolina return, North Carolina just passed the rule a few weeks ago that you no longer had to do that add back. And so now they're requiring you to amend your return to take off that add back and to get your money back.
Yeah. Okay. All right.
Actually, research I was doing today showed that if you added back the EIDL or SBA loan repayments, where the SBA paid your loan for 6 months, those are also now not add backs for North Carolina, as far as what I could tell. Yeah.
Okay, so there you go. Got some money coming back to you, maybe. Yeah,
Potentially,
you definitely
yes.
want to get on that. You know, we always like when we get some money back, right? So that's why we're having this conversation, is to just help you be mindful of things that you could be asking your professionals. If you don't have one, I've got some good people right here. You may want to, you know, check in with them. They're with Mitchell Nemitz, and you may want to find out some things about what you can do in your particular situation. But, you know, we all want to make sure that we're, you know, maximizing, you know, our earnings and the monies we make and how hard we all work, and just want to make sure we've got the proper information. Should everyone be an LLC as an individual?
Find the tax calculation. You want to field that? We're going to field it.
Just as an individual
Okay.
person?
I would say,
All right.
yeah.
Is that what-
It completely depends on the situation,
Yeah,
I would say.
yeah.
So,
So the thing is, a LLC is simply a legal entity. Same thing as if you were a corporation from a legal standpoint. And so with an LLC, that doesn't necessarily, the LLC itself does not define how you're taxed. And there's really actually no specific LLC tax law. The way it works is, if you're a single member LLC, then you are automatically considered a sole proprietor for tax purposes. So
Okay.
if you're operating a business, you file a Schedule C. If you have an LLC with rental properties, you're going to file your rental property activity on Schedule E. If you're a farm operation, you would still file on Schedule F. If you're a LLC with multiple members, you're automatically considered a partnership, and you would have to file a Form 1065 with that. But being an LLC, you also have the ability to elect a different tax treatment, such as S corporation and C corporation. And so the LLC provides you a lot of different flexibility, but depending on your structure, depends on how you're taxed. And there again, with that, just like with the like-kind exchange, I would consult your tax professional to determine
What's the best
what
way?
is
It
the
often
best way for you to be
depends
taxed.
on your income as
That's
to
right.
what is most beneficial.
That's right.
Okay, cool. Great questions. Thanks for that. All right, so anything in closing? Anything in summary? Any closing point you want to make? Because we're going to close it out in just a minute.
I would say don't be afraid to ask us questions.
Yep.
Don't be afraid to consult a professional. We're there to help. That's literally our job.
Yeah, I mean, there's never any dumb question, but especially when it comes to this stuff, you know, just ask. I mean, that's the best thing you can do, and
Better
you'll
to ask than
That's right,
err.
right, and then miss
So,
out on
yeah.
opportunities or find out you could have done something, and then you're kicking yourself. So yeah, absolutely.
Correct.
All right. Well, if there's no more questions out there in the audience, and we've covered some good ground together around taxes, from home ownership to buy-sell to home office to, so we touched a little on business and structures, which we can definitely dive into more next time for sure. I would love to do that, because I think there's a lot of questions in that space.
Yeah.
But just the bottom line, keep copious notes, keep all your documentation, and ask questions. If you don't have a tax professional, then make sure you do find someone that can start helping you out. And if you live here locally and you're not working with anyone, you know, consider reaching out to Mitchell Nemitz here in Wake Forest.
Yeah.
Thank you.
Thank you all. Thank you guys.
Thank you,
Appreciate
Thank
it.
you.
for
Thank
having
you
All
for
right.
having us.
Have a very Merry Christmas.
Merry
Merry
Christmas,
Christmas.
everyone.